Welcome everyone to another edition of our weekly crypto chat, presented by Huobi Research. I'm your host, Jet, and with me, my colleague Hanson as your co-host. Today we have two special guests that we'll be introducing later. As usual, please be sure to follow us at Huobi_research on Twitter or huobiresearch.medium.com, where we have a number of different reports that we present on a week-by-week basis, with the latest being the Fear, Uncertainty, and Doubt report by Dave, and then also an Epic Games report by Hanson. As usual, be sure to leave your questions in the channel, and we'll get to them at the very end of the chat. And just to note, as usual, note that everything said here is not investment advice and does not represent the opinion of Huobi or Huobi Research. These are our own personal opinions on each individual issue, so just to be sure of that. So with that said, let's kick off, right? So for this week, a number of different issues, and with the, again, first and foremost, being the crypto market contagion, right now Bitcoin has stabilized at around 21K, over the last week, as well as ETH at 1.2. This is mainly off the back that, we've seen a rally in traditional financial markets where S&P and NASDAQ for the last week have both been up around 6%. So this week, further analysis and discussion on the crypto market contagion. We'll also be touching upon, the latest announcement by Solana in regards to the launch of their own phone. And then we'll be diving into, Uniswap's, some M&A activity, buying Genie, which is an NFT aggregator. And following that, we'll be talking about DYDX and its announcement moving towards having its own layer 1 chain on Cosmos, followed by some NFT updates as usual on Doodles as well as Shopify. So with that said, let's dive in, right? So, this week, as usual, given the fact that, 3AC continues to, cause, trembles across all, across the crypto markets, with the latest being, Voyager. So Voyager is similar to some of the other crypto CeFi platforms that we've discussed in the last few weeks. It is a multi-service crypto platform where you can borrow and lend crypto on its platform. And what had happened was, in Voyager's case, is that apparently they had a significant amount of exposure to 3AC to the tune of over 600 million, right? Which is pretty astounding if you think about it, because of the fact that its own entire loan book was only around, I think, $2 billion, and around 60% of that was to 3AC on an uncollateralized basis. So pretty astounding. And just to note that, right? So with the latest announcement, they've also received Lifeline by FTX and Alameda Ventures and Research, where right now, I think that the preliminary terms from what I know so far is around 200 million. And based on the latest news that I've seen circulating around, they've tapped in already around 75 million of that. So right now it's still, I would say right now it's kind of like calm before the storm, because of the fact that a lot of these major CeFi platforms are being worked out, and rescue packages are being formed to determine whether or not they live. Right. So with that said, right, like this week, just to note that we have two special guests with us. Also part of the Huobi Research team, Dave, which you guys met last week, as well as Johnny. And we'll just be opening this up as a discussion kind of panel, just to talk about in Voyager's case, what happened, and what are the ramifications that we can probably potentially expect, right? So Johnny, I know that you just recently took a deep dive into the exposure with 3AC and the contagion effects around that. So what do you think about in Voyager's case and I think overall, so to speak?
I'm thinking about there is actually a cascade of liquidity crisis happening in the crypto space. A lot of trading firms and also fund managing companies, they have already been affected by 3AC's liquidity crisis, since as Danny from 8 Block Capital in Hong Kong tweeted on 16th of June that 3AC actually has been borrowing a lot from different protocols, different lenders. 3AC used the money they borrow to leverage loan on Bitcoin, and also they have some aggressive investment, for example, particularly in the investment in Luna and also UST, which made them lose around almost $500 million. And that's a big tragedy happening in the space. And the Voyager incident, revealed the risks and also the insecurities that if some fund managing companies and also trading firms, if they have a lot of capital and they do not exercise proper risk management, also asset allocation strategies, that's dangerous to the space. That's very dangerous, and it's detrimental to the organic growth of the whole crypto space. And hopefully we'll learn something from it. We will have, I think we will have better risk control in the future, because 3AC, it was a very, very, like our first teaching. It taught us how to, avoid similar tragedies from happening. Yeah.
Yeah. No, I definitely agree, right? Because I mean, I guess the question is, because of the fact that we were in a bull market for so long, so much of this risk management was kind of like, swept away under the rug, where a lot of people, because everyone was making money, didn't ask a lot of questions. And I think that's exactly the case with what you just mentioned, right? Because of the fact that a lot of this risk management was not really considered, because again, 3AC was a well-known, well-established crypto hedge fund within the space. I think Voyager probably initially had a smaller limit to them that was extended, and then throughout the bull market, it got bigger and bigger because of the fact that I guess they got more comfortable and thought that 3AC probably made a lot of money, right? So so
just
I
a quick
Dave, go ahead.
Go ahead.
Just wanted to get your take on it as well. What do you think?
Just a quick cap. I think that's really a cascade of liquidation for the institutions. For crypto world, like before 2020. So we have like a cascade of liquidation for the retail users, and the effects is not as magnificent with compared to the liquidation points we have nowadays with the institutions. So according to the Wall Street Pro on Twitter, so we have now sort of like 14 institutions that have exposure to the regulations, and also the suspension of withdrawal funds. So I'm here to remind our audience that if you have exposure to the following, like Celsius, 3 Hours Capital, BlockFi, the crypto lender, Genesis, Nexo, BigMix, Finbox, Babel Finance, the crypto lender, Orthogonal Train, Maple Finance, Voyager, and Conflicts now. Even Conflicts has the impact for the based on the suspension of the withdrawal, that it has a total trading volume of nearly like 2 trillion. I haven't verified it, but it's trending on Twitter. So probably this is going to have a big impact for the liquidations.
Yeah, no, for sure. I mean, definitely, I think right now, a lot of the bodies are still kind of being dug up right now to really understand which, CeFi lender or DeFi protocol, have all these, networks and web effects that's linked to a 3AC or a Celsius, right? So I want to turn over to another different point on the Voyager, right? So we've seen with Voyager as well as BlockFi, we've seen announcements about FTX kind of stepping in to kind of help out the situation by throwing revolving credit lines to these institutions. What's your guys' take on that situation? So I'll start with I guess Johnny. What do you think about these credit lines being extended?
I think you mean the Voyager incentive?
Yeah, so I mean, like, I think right now we've seen that Voyager has got a $200 million credit line from FTX, and then for BlockFi, I think they secured like 400 million. Correct me if I'm wrong. From also a revolving credit line. So I mean, maybe I'll start off first with my personal opinion. Right?
Yeah,
So
I actually have something to say. Yeah.
Yep.
The credit line is something like a bailout solution to Voyager, right? Like a bailout solution. they have certain conditions for Voyager to meet in order to release the bell. I remember I looked into something like that, and we need to gotta evaluate these conditions, right? Because if some conditions is unable to be met in the future, for example, if Voyager really can get back the loan they lent to 3AC and it went bankrupt, and or some operational problems appear in the future, and it's not a must, right? The bailout, the credit line, and I think FTX is really assessing the risks with Voyager. It's like they purchase Voyager at a discount, right? They want to own their asset, and some risk as assessment really need to be done to safeguard the whole project.
Yeah, no, for sure. I think yes, especially because of the fact that I think right now for Voyager, the situation is, as you said, right? We don't know what the specific terms are revolving around this credit line that's being thrown to them. And similar case, also for BlockFi, right? So I think right now, on the BlockFi situation, it's a similar situation where they got a lifeline, so to speak, from FTX. But apparently, a lot of these conditions are very onerous and very, I would say, stringent because of the fact that I think right now we don't know if they're going to go bankrupt. I think no one can really say if any of these will go bankrupt, right? And the main issue is specifically in relationship to the BlockFi loan. I've heard or I've read basically the reason why BlockFi signed the initial preliminary term sheet for this loan, as opposed to all the other deals that they got, was because this one with FTX put the priority of the depositors first, right? So what does that mean, right? So in a bankruptcy situation, usually the assets get divvied up by the creditors, right? But in this case, the facility that was extended to BlockFi actually first prioritized anyone that deposited money in BlockFi first, and they could get the money back, and then the creditors will be next in line, so to speak, to tap any of the remaining assets. So I think that's the main reason why they are considering heavily this deal, because of the fact that I think it will really put a black eye to the whole crypto market and crypto industry if depositors lose all their money and creditors get all the assets, and no one can basically withdraw any money out. So I think this is what's right now the main priority for all these lifelines, or so to speak, where I think everyone realizes retail cannot get completely screwed over here, and that's exactly what's happening. So.
Yeah, right.
Okay, so let's move on, right? So I know, Johnny, you did a research report analyzing, some of the exposures of 3AC and some other trading firms in relationship to Maple Finance, TrueFi, and then also the trading group Amber, right? So how about you walk us through what your findings are?
Yeah, of course, sure. Yeah, I would like to share my screen. So yeah, I'm gonna swift a bit, and can you see my screen right now?
Yeah.
Yes.
Sure.
Yeah, cool. Oh yeah, on the left hand side we have the liquidation data retrieved from Parset Finance, and on the right hand side is the recent research that I've been working on, and later on I will use some I will source some information from my report to explain and walk through you guys. The main thing I want to talk about here is that I actually looked into the lending ecosystem in crypto, and I found out that the conclusion is that risky investment strategies not a good thing. It's very dangerous to the organic growth of the whole space. And firstly I want to talk about the liquidation events caused by 3AC, and also some trading firms and fund management companies closely related to 3AC, probably 3AC's investors. And if we look in the data here, DeFi liquidations on the bottom, the chart, red candles, we can see. Wait. Yeah, we can see that there's a particularly big liquidation event happening on Saturday. And if we look into the monthly chart,
Hey, can you zoom in the graph a bit more? We can see.
Oh, all right, yeah, I'll enlarge it. Yeah, wait. More clear now?
Yeah.
Right? Yeah, very good. Yeah, on the right hand side, just look at the data here. You can see roughly around $300 to $400 million being liquidated, since 12th of June, happening across that week, and probably it's due to Celsius and also 3AC's liquidation events. And I think it's 3AC's liquidations because they have very tight margin calls, and they probably didn't have liquid assets to cover the short-term liabilities. And if we look at the liquidation data, liquidation prices now, this is Ethereum liquidation price, and we see that the liquidation prices, the liquidation zone concentrates on 800 to 600, around these prices. That has fallen significantly, probably due to a lot of fund managing companies and also trading firms have now adjusted their risk. They knew that if they don't deleverage their positions, and also they don't pay the debts, they would be in danger. And that's why we see less risk now, because liquidation prices have fallen, and now currently the prices of ETH is standing around 12K, 1K, 1200. And if we look at Bitcoin here, let's go to Bitcoin, WBTC liquidation price. Just a minute.
So I guess in the meantime, Dave, I know you also did some work revolving around, I guess, these liquidation data and your fear, understanding the fear and uncertainty in relationship to the market players. So what do you think right now in after a whole week of volatility? What's the current situation on your side that you think?
I think the current situation on my side is like we still have a sort of liquidation points close to the current price. So now we can see that ETH is sitting on like $1,200, but we have the liquidation level that has the amount of total liquidation volume is total to 230 million. So as a last check, it's like 4 days ago. So there is a liquidation point of where ETH is equal to $977, and we have that sort of amount of 230 million, and that's pretty significant. And we also have the stake ETH to ETH liquidation data, so we can see that on Passive Finance, where I really recommend people to check it on with the on-chain liquidation data. There's the PAR SEC.finance FINANCE that we have when the ST stake ETH achieves the ratio of lower down to the 0.8 ETH, we have the liquidation volume totaled. It's going to be like 350 million, so it's going to be very significant. So John, do you have anything in the final?
Yeah, actually, what we need to worry about is if there's more liquidation coming ahead in the future. And that's what we need to drill into and need to find out. And I'm worried that because I found out that Maple Finance and TrueFi, these protocols, actually they offer uncollateralized loan to institutions. And after we learned that the implosion of 3AC and also Celsius induced a lot of liquidity crisis across the space. And what I think is that uncollateralized loan can be as dangerous as leveraging on collateralized lending protocols like Aave, DAO, and also Compound, because you don't have anything to back up the loan, uncollateralized loan. And we can actually look into the pools. Actually, on Maple, we have like 5 pools there. And let's look into the biggest pool, orthogonal trading. This pool is actually managed by orthogonal trading, and the manager, the orthogonal trading, is also called the pool delegate. And what a pool delegate does is that it manages the pool. It deals the loan agreement with borrowers. They deal with the interest rate. They deal with the terms. And also, if we look into the pool details, like what are the loans that currently are active, and we can find out that the big lenders are Alameda Research, Amber Group. These two actually borrowed like here millions of dollars, and you can see Amber Group borrowing $32 million in USDC. And if we look into other pools like Maven, actually the same company, we can see the big borrowers are Alameda Research and also Amber Group, borrowing a lot of uncollateralized loan. And what we worry now is that the cascade of liquidation crisis already happened in the space. And what if the ripple effect has not finished yet, and there are more to come? Because uncollateralized loan are riskier than collateralized loan, because in case of default, what if the borrower does not have any money to return the loan? And if you have collateralized loan, you have to sell the collateralized. All right, the lender can take the collateral and just sell it in the market to secure their funds. But in uncollateralized loan, just look at Babel Finance. Babel Finance borrowed like 10 million from the orthogonal trading pool, and Babel Finance paused all withdrawal last week because they encountered the liquidity crisis. And now orthogonal trading, the pool delegator, is actively contacting Babel Finance to deal with the problem. And I wonder what they can do with it, because you don't have collateral to sell, you don't have anything to secure your funds, and what lenders can get is just we call like something like insurance, a pool coverage fund. And if we look into orthogonal trading, we have the pool information. You can see that the pool delegated cover distribution is like 700K. And comparing to the pool size, comparing to the loans that they issued, like 500 million, outstanding loan 200 million. I think that's like less than 1% of total pool. So the safety issue and also the risk here is very high, and I think it's very dangerous.
Yeah. No, for sure.
Whether Amber Group and also these big borrowers. Yeah, you talk about it.
Yeah, no, I think I just wanted to highlight, I guess, to make it maybe take a step back and briefly kind of explain the concepts, right? So yeah, Johnny, as you mentioned, right, like for collateralized loans, the reason why, even though in a liquidation event, the person that pledged the collateral is forced to sell it to cover the loan, causes sell pressure. At the end of the day, you still get potentially 80 cents on the dollar, even in a bad liquidation scenario, and you weren't able to liquidate fully, right? But the problem with an uncollateralized situation is, if you think about it, right, I'm basically borrowing based on the good faith and trust of the counterparty acting properly and being able to repay through cash flow, as opposed to hard assets, right? In a collateralized situation, you have hard assets to always fall back on. In a uncollateralized situation, you have only cash flows from the firm. And in this case, because of the fact that like a 3AC or like these lending pools that Johnny has mentioned, right? Without these trading firms making any money, there isn't any cash flow to repay this debt. And that is the main concern here, is because once people start facing a significant amount of losses where cash flow completely dries up, then anything on these potential trading firms' books is all free for all, right? So potentially tokens and other crypto assets that we might not even know that they have exposure to will potentially get sold in order to raise any type of cash. And I think that's what we've seen in the last few weeks. And exactly the point, right? And to just highlight on the point about the insurance part. So typically, I think for Maple, what they've kind of done is they kind of tranche the risk, right? So tranching of the risk means by usually in traditional finance, what happens is if you have a risky loan, you have a senior tranche and a junior tranche, right? So the junior tranche is the first loss capital, where in case like the borrower does not repay one or two payments or misses out here and there, that is going to be used as the first, the pool insurance is going to be the first part of the capital that is going to be used to repay the senior lenders in case of any of these minor issues. But the problem is in our situation or in the current market situation, because of the fact that the losses are so significant, this pool insurance is completely wiped out already and it's eating directly into the senior loans that Johnny's talking about right now.
Yeah, absolutely. Yeah, that's what we're worrying right now.
Yeah. So Dave, I mean, or Henson, I mean, do you guys have any stance or position on with all these on chain, so I mean, I guess right now for uncollateralized lending on DeFi, it's still pretty nascent compared to I think what we've seen with Celsius and 3AC because of the fact that I think we've only seen a few of these emerging. Mainly the most well known are Maple and TrueFi. What are your guys' take potentially on this?
I think like what the situation is like. I think is that the situation is closing to like institutional level of what we coordinated call it like rug pulls, because it's like when we as retailers like the old days when we think about if we can pull out a lot of financial amounts that from institutions, that I think the crypto world is going to be great. It's going to be awesome. It's going to be full of rainbows and stuff. But actually, when we look at what is happening right now, it's like the institutions are borrowing loads of loans that with their reputations, with their enterprise values, with their credibility, and what resulted is like they are not able to return the loans. Now, 14 institutions are not able to return the loans, and who said and who knows if other exchanges are also having the same issues. So what I'm concerned is like it looks like when institutions are coming off into the battleground with their retails or the battleground in cryptocurrency, well, we see a more intensive level of the liquidity crisis. So I think that in the future it may be a a good scenario or good solution that if we can have a regulated stress test or a community driven stress test on the liquidity level of the institutions or the protocols, I think it's going to be better. So what do you think about that?
Yeah, no, I think definitely. I think with this crisis, there's probably going to be a lot more, I guess, requirements on the transparency. Because I think end of the day, the reason why 3AC was able to borrow so much money was, I mean, to be honest, they did have some, I would say, not so legitimate, methods towards borrowing more money. Basically, I think from what I've seen on Twitter and what people have kind of communicated, is that they kind of failed to disclose that they have a significant amount of borrowings from other firms, and because of the fact that when you think about it, right, if I go to a bank and I borrow money, the bank is usually not going to call up other banks and see if I borrow money because they want to compete and win my business, right? And that's exactly what 3AC kind of took advantage of because of the lack of clarity there. They're able to go to basically all these institutions and basically say, hey, we're interested in borrowing a loan and pursuing a loan. Are you guys okay with it? We're 3AC, and let's get this done, right? So basically through that rinse and repeat process, they're able to borrow a significant amount of money to a number of different counterparties without the counterparties realizing that how much debt they actually have on the balance sheet. And that's why I think we've seen this kind of playing out as similar to, if people are familiar in the traditional finance world, I think a year or two back with Archegos. This is the exact same situation where Archegos borrowed a significant amount a ton of money from a number of different investment banks, and failed to disclose all these interlinkages between and all these inter-borrowings between all these different firms. And that's exactly what's happened with 3AC because of this opaque, structure that we have right now in place. I mean, to be honest, it's probably not going away, but I think with probably more regulation down the road, we're probably going to be seeing a lot more transparency for a lot of these, financial services providers like BlockFi or Voyager, if they survive, on the disclosure of who their counterparties are, how significant of a concentration there is to each individual potential counterparty. And I think that's probably going to be what's going to be coming out at the end of this tunnel. So yeah, I mean, I think, yeah, we can probably move on. I mean, I want to go into probably, I guess we've talked about CeFi. Let's move on and talk about some projects on the DeFi level, right? So on the next slide, we have Bancor. So just to give a quick introduction, if people are not familiar with Bancor, Bancor is basically the OG, decentralized AMM, right? So AMM stands for Automated Market Maker. So right now, the largest automated market maker that everyone's aware of is Uniswap. So Bancor is actually one of the more preceding or OG projects that was actually founded in 2017 that actually came up with the original XYK concept of a liquidity pool. But the main issue is, I think Bancor, has a very big team, has been in the space for a very, very long time. But I think with the bull market and a lot of product and features being rolled out continuously, in the bull market, people don't really see flaws in a lot of these features being rolled out. And I think right now, what had happened, to give a quick summary of the situation. So Bancor, through its latest version of its liquidity, AMM pools, offered impermanent loss protection 100%. So to quickly just recap, impermanent loss is when you provide liquidity into one of these automated market makers. When the price moves in either direction, the amount of assets that you receive back, the composite is not the same potentially as if you entered in. And this is mainly because of the fact that the price of the two assets have now moved, right? And that is called impermanent loss, because technically, if the prices move back to the original price of when you entered into the pool as a liquidity provider, then you face no loss. But usually within crypto, things go up a significant amount or go down a significant amount, right? So as a result of that, that's why usually impermanent loss is faced by any liquidity provider on these AMM protocols, right? So Bancor came up with a rather unique idea, at least that was at the time, basically of proposing 100% impermanent loss protection. So how is this done, right? So this was done mainly because what they would do is they would issue you token rewards in the form of their native governance token Bancor, so BNT, to basically supplant any potential impermanent loss that you face. And through this calculation, if you were to pull your liquidity out at a certain point in time, they would, based on the duration and time that you've spent in the liquidity pool, I think initially, from my recollection, the longer you stayed in the pool, the more coverage you would get, up until 100%. And basically through that, you are able to protect any type of price volatility from your liquidity position through earning these Bancor tokens, okay? However, because of the current situation, if you think about it, prices now moved significantly down, and a number of liquidity providers are now pulling a large amount of capital out of these liquidity pools, right? And as a result, that's what you're seeing is a downward spiral effect similar to kind of Luna and UST, because of the fact that when they promise this 100% in permanent loss protection, more and more BNT tokens get minted, right? So when more BNP tokens get minted, what happens is basically the price of BNT goes down because there's more sell pressure, right? And apparently, I think some people have identified Celsius to be one of the major Bancor liquidity providers. So Bancor was Celsius was basically dumping a significant amount of Bancor tokens and cashing out all their liquidity positions and taking all those rewards and just selling them into open market, causing the price to go basically on a downward spiral, right? So now that I've kind of set the stage on the Bancor situation, right? I think it's good to probably discuss with you guys, right? I mean, this is a clear case of the fact that a lot of these potential features are not really battle tested for a potential black swan event, right? And this is exactly the downward spiral that we saw with Luna happening to Bancor, a very well-established and very OG project. So my question to you guys is like, I guess from all this that's happened, like, what do you think about product feature rollouts and potentially whether or not there should be a lot more testing involved, and whether or not for a problem as big as impermanent loss, was the marketing a little bit, I would say, overly, I would say, bullish because of the fact that technically it was able to protect it in the good times, but in the bad times, what they actually happened was because of this downward spiral, they actually paused and not gave out and handed out the impermanent loss protection rewards and halted that, right? So what do you guys think about that in general, about the whole situation with Bancor and for DeFi in general? Is there an incentive mechanism, a gap right now because of the fact that we were in a bull market for so long? A lot of these features were just not well thought of. So maybe I'll start with you, Johnny.
Yeah. I think we need to be really careful with these, very special innovations coming up in the bull run. Not only Bancor, but also, we have some algorithmic stablecoin issued by Lunar and UST. Some of them are really interesting because they offer something we haven't seen before, just like how algorithmic stablecoin works. They have 2 tokens to maintain the tag. Yeah. And in the case of Bancor, I think ultimately comes down to one problem that I worry about is infinite inflation. If they can, mint as much BNT as they want, and then what's the value? Who is there to support the full level? And I think in bullish environment, everything looks great, just like what Dave mentioned. Floors won't come out in bullish environment. Everything going up, and people are excited. And what this tokenomic shows us is that it cannot withstand. It actually has problem. It has errors. It cannot withstand bearish market. And the problem with Bancor is that is some people call it a scam, right? On Twitter, the Hasu, the guy thought that it's more like a scam than some innovation product. And I think he got a point right there, because I personally don't think that having infinite inflation, also unlimited supply of BNT, is a good thing to the organic development of the project itself. That's my point of view.
Yeah, no, for sure. I think the main difference is like marketing, as well as I think a lot of education is missing, right? I think a lot of people potentially that LP'd for Bancor was not fully educated about the potential risk with this feature, right? Because I think for me, I have a finance background. I think it's a lot more easier for me to kind of assess the risk associated with this. But then for the average person, right? Like, it sounds really good. I mean, sometimes it sounds too good to be true, and you definitely need to be careful of that. And in this case, for Bancor, right, 100% protection on impermanent loss is a problem that no one in DeFi has solved yet so far, right? So for them to come up with such a great solution to a problem, I think it warrants a significant amount of scrutiny and understanding and assessment because of the fact that it is such a novel potential take on solving a problem. And again, in crypto, because all of these projects a lot of them are just very early stage testing, right? And because of that, definitely users have to be mindful of the fact that a lot of these features might not be around once a finished and finalized product probably rolls out, down the road. So, I mean, Dave, I guess you probably used some DEXs before. Like, what's your opinion on the DEX experience and the Bancor situation?
Yeah, I pretty much used a lot of DEX before, like like Curve, mini swap, sushi swap stuff, and Bancor is pretty much a very good OG, DEX that I used. Then I think that a lot of retailers, really fall into the trap that know how to protect people from the impermanent loss, by minting more and more banks and token. So I would like to jump out to the stuff that why do we have cryptocurrency to as a crypto sort of like close to OG, but like for us that why we wanted to create cryptocurrency is that we don't want to be associated with the how traditional finance is working, or at least we want to improve that. We want to change it to the fact that unlimited printing is not going to work, and it's going to hurt average people, and we don't want average people to pay for the cost, to harm the average people from the financial impacts. So if Benson token is printing unlimited, so what's the difference between the printing unlimited US dollars and printing unlimited random tokens to sort of relieve or to delay the impact of the unlimited inflation? So what I think is that in the next bull run cycle, we're gonna have more innovations and more solution on protecting people from inflation, and a lot of impermanent loss. The curve with the impermanent loss. With different x times y is equal to k. With the curve not that flattening, so that we can reduce slippage. But we also have to look at the downside risk, whether they are having a solution that is just marketing, or whether they are having a true solution, or at least something innovative as Kuiper network for the dynamic market makers, or is actually having just delaying the impact of inflations. And what I think is people have to look on more of the downside of the cryptocurrency, and the sort of organic growth. The second part I would like to express is organic growth, that they are protecting people from impermanent loss, but where is the capital flowing from? Like they mint the new banks token. So where is the capital? Supplying the capital for the new minted banks token. I think it's like printing out of the thin air. But when you look at organic growth like Centrifuge and also Goldfinch or any other sort of like RWEAF, that there are like miners and users paying for a one payment permanent storage solution, and these are really organic flows that someone is paying for a product. So when users or the DeFi investors are investing more governance token or other no investment advice though, but if you really are investing in any of sort of like these DeFi protocols, you gotta watch the downsides. Where the capital is flowing from? Is there sort of like organic growth, or is that growth sustainable? Yeah, that's sort of my 2 cents.
No,
Yeah,
I
I
definitely
think
agree. Yeah, go ahead, John.
Yeah. Yeah, I think Dave got a point, and I really want to elaborate on Dave's idea that we really need to differentiate the difference between marketing, good marketing, and true value. We want to see something valuable in a project, right? We don't want to see speculation. Actually, speculation is not good for a project, because that's where demand is not met with the supply, right? Came switched off, right? And we want to see organic growth instead. That's why I totally agree with Dave that we really need to look into the downside. We need to study the problems and errors that these protocols are having right now in the bearish environment. And I think it will be a potentially a beneficial wipeout for all of us in the crypto space, because we learned something from it. I definitely think that we are going to learn a lot from this bearish environment, and probably in the next bull run, just like what Dave said, we'll have more innovations. But these innovations, we expect they bring values to us. They bring value to the community, but not just some superficial marketing and also influencers, that type of stuff.
Yeah, no, I definitely agree with both of you guys. Right, end of the day, I mean, I would be a little bit more balanced, because I think speculation end of the day is key and a requirement of any type of financial market, because end of the day you speculate on the upside, and that's why you would want to buy a certain project. But at the same time, I think we've seen this bear market and this downside, cycle that we've seen so far, that definitely everyone has to be well aware of the downside risk associated with each and every project, because there are risks, and if you don't know what they are, you probably are going to be the one that's going to be hit with a loss. So let's move on, right? So I guess, it's been a great conversation so far. So I would really want to just, jump through a few of these, not as time consuming topics, just so we can hit them off the bat, right? I guess turning the page from a topic as big as Contagion and the crypto markets in general. Solana announced its new phone, Saga, and basically what the idea is right now I think UI/UX is one of the main issues surrounding crypto adoption, and because of the fact that right now a lot of the applications are still browser based on computers. It's not as easy for a lot of people to really access it on on the go basis, right? And I think that's the main reason why I think Solana kind of thought a little bit differently from everyone else, and potentially try to differentiate themselves and build out a product where it can also be your cold storage wallet. At the same time, it can tap online and access applications on the go. And given the fact that everyone has a mobile phone, that's why they've launched this latest mobile phone. So just wanted your guys' quick take, a quick, recap on what everyone thinks on this phone that just got announced.
Yeah, so we know that at the moment, many D apps do not work really well on mobile devices. So, but I don't think Solana need to build a dedicated Web3 phone to improve the accessibility and functionality on mobile devices. Instead, they should be focusing on helping the apps on the software side, so making them more competitive and user-friendly on mobile devices. So making a Solana phone, in my opinion, is that it's just a bit unnecessary and too risky from a business standpoint.
Yeah, I mean, I would disagree a little bit, because I would say right now the main reason is, if you think about it, right, the problem with using an iPhone or any other, I would say like a Samsung or whatever, you don't have control any of that hardware, and I think that's from a security standpoint, setting up for crypto level security to hold any type of tokens. I think right now it's still the key risk. Like, end of the day, right? I don't think a lot of people want to hold their ledger or Trezor wallet around, and then have to always connect it each time they want to access any type of crypto, right? And I think this is kind of like trying to blend, more security with better UI/UX. I mean, of course, do I think that this launch of this first V1 is a good idea? Who knows, right? But I'm a little bit more open-minded to it, because of the fact that end of the day, when we first saw the iPhone, no one thought it would work. It was a camera and basically a phone, right? And a big screen, right? That's all it was. There was no applications, no ecosystem, nothing built on it. And I think we might be seeing the first iteration of what might be to come, right? So definitely a bit more open-minded to it. What are your guys' take on it, Johnny and Dave?
Hey, Johnny, do you just mute the mic?
I muted my sorry. Yeah, it's a very interesting thing that I learned something about Solana phone, and I'm definitely, I want to see more of it, because I haven't been researching about this in this applications, hardware application. Maybe Dave, you have more ideas about it, right?
Well, probably I haven't done a lot of research on the Sega phone, but what I know is like Sega phone actually creates a unique market, a proposition for Solana for the moment, for now on the market, because all tokens, all the chains, all the layer ones, like ETH, like Near, like Solana, like in and out of like Cosmos, that you can't find firms connected with a blockchain network. So if it really works, it's kind of like Apple, like Steve Jobs back in 2002, that period that no one even thought of, Apple that has the iPhone. So if Sega really works, if the bottleneck that Solana is really having for the fact that they have DDoS attack, and they can not function pretty well like any other chains like Avalanche, like Cosmos, like and similar to Near, that it shuts their protocol down. So if they can work with their 65K TPS connected with the phone as a Web3 product, and that's going to bring a huge amount of revenues. As a crypto native, Web3 native, I'm definitely going to buy that phone, but under condition that Solana is decentralized and Solana is not going to shut their network down. So probably if two of the ingredients are going to combine together, I think it's going to be working pretty well. But if it doesn't work either way, it's going to I don't have a optimism on that. What do you think, Jen?
Yeah, no, for sure. Yeah, I think right now it's too early to say, but definitely just being more open-minded to it, because like end of the day, who knows? This is version 1. We'll probably see more of it as the time goes by. So definitely just on the lookout. So let's move on. Right? So Hanson, I know you taking a look recently on some M&A activity more on the NFT side. So tell us about the acquisition by Uniswap.
Yeah, so last week Uniswap has acquired Genie to expand their products to include both NFTs and ERC20 tokens. So Genie is NFT market aggregator. What it does is that it consolidates the NFTs listed for sale on all the marketplaces and platforms into a single large catalog. So it allows users to bundle buy NFTs across different platforms in a single transaction. So I think acquiring Genie, it really fits into Uniswap's ecosystem, because Uniswap is trying to become the ultimate decentralized platform for all digital assets. So having a tool like Genie will fill in the gap they're missing in the product category of NFTs. And one of the issues when buying NFTs right now is that most of them are priced in Ethereum. So we're likely to see that Uniswap to try provide flexibility to NFT buyers by allowing NFTs to be purchased with any type of ERC20 tokens with the help of the Uniswap platform.
Yeah, no, for sure. I think definitely, given the fact that, right now, bear market, those with cash will probably look to acquire some of these competitors of theirs or try to assimilate and vertically integrate. And that's exactly what we're seeing here. So let's move on, right? So next on the topic, just wanted to let you guys know, so DYDX is one of the most famous layer 2 decentralized perpetual exchanges out there right now. And they've announced that they're going to be deploying on their own blockchain on Cosmos, I think sometime later this year, end of this year. And I think, there's a lot of debate right now going on between whether or not, whether layer 2 tech can potentially, be the guiding light of a lot, and basically help Ethereum scale, right? But, on the other hand, right, with DYDX migrating towards its own chain, it also puts into question whether or not potentially there are some certain trade-offs, right? For example, right, when you move to your own chain, you have more control over, the validator set, actually programming, I guess, the specific native criteria within your blockchain, block prioritization, et cetera, et cetera. And I think, these trade-offs are definitely going to be a lot of, debate heading forward about whether certain applications should migrate to its own chain, or whether or not, Ethereum remains the main testing ground, and the composability of, being able to connect between different types of programs and applications makes sense from a network perspective. So definitely something to keep an eye on, TBD, right? So moving on, some more further NFTs that, I think Hanson, you took a look into. So how about you walk us through what your findings on Doodles?
NFT NYC ended last week, and despite the bloodbath in the crypto market. People seem to be still genuinely excited about the future of NFTs. So projects were able to deliver beyond expectation and surprise their fans during the event. We saw multiple A-list celebrities like Madonna, Eminem, and Snoop Dogg performing in the stages. And one of the projects that really stand out in NFT NYC is Doodles. So they have they announced their new roadmap, which includes onboarding famous singer Pharrell Williams as their brand director. And Doodles also partnered up with Shopify to create both unique online and in IRL experiences for their holders. So they introduced the first ever IRL minting machine. So people could use these machines during the NFT NYC event and mint Genesis Box NFT, which can be used later in their future NFT collection. So the machine takes credit card as payment, which is powered by Shopify. And so Shopify allows NFTs to be minted using credit cards, thus saving consumers the trouble of getting Ethereum and connecting their wallets to mint.
Oh, cool.
And so they also partnered up with Shopify to create an exclusive online storefront for their NFT holders. So Shopify's new token-gated platform aims to recognize and reward NFT holders, so granting the special exclusivity for owning NFT. So they will help projects to launch merchandises from scratch, so all the way from design to delivery, and also provide credit card payment services, saving consumers the trouble of using Ethereum and paying high gas fees when buying stuff. So I think Shopify supporting Shopify as a traditional e-commerce platform will help bring NFTs to mass adoption, because it removes the barrier for the public by simplifying the NFT minting and payment process. And the Doodles IRL minting machine experience really show the potential of having minting machines, physical minting machines in the public that are powered by credit card payment systems. So in the near future, it wouldn't be surprising if we see these physical minting machines for NFTs as much as vending machines for things like toys and candies. Yeah, that's pretty much to say.
Okay, so yeah, let's move on to I guess today, we also have a Candydrop event as usual. So during this time, I would just like to remind everyone to be sure to leave any kind of questions. We'll get to them. Today's a little bit running over, but we'll get to them as soon as possible. So Hudson, how about you take it away and just introduce the event?
So as usual, we will try to introduce about Candydrop event. So users with an average trading spot volume above 100 USDT of any digital assets for the last 3 days can register for the event. And participants can win up to 100 USDT per entry and up to 1,500 USDT per week. So I mean that the more volume you have, the more entries you can register, and the higher your chances of winning are. We will also airdrop Candydrop double-up coupon to anyone who did not win anything. So using the coupon will double up the chances to win the airdrop, and you can stack up to a winning chance of 100%. And moreover, for each Candydrop event, one lucky star winner will get a grand prize of 1,000 USDT. So you can go on to the Huobi app and click on the new listing event page for more information.
Okay, so is there a password today? Just to make sure.
No, there's no password for that for today.
Okay, so I think there's one quick question that we can probably get to, and this is, I guess, a question on everyone's mind that I saw on the chat is, when do you guys think will be the next bull market, and what do you guys think about the intermediate price estimation for Bitcoin in the short term and long term? So maybe Johnny and Dave, you guys start.
Yeah, what I think is that we don't try to predict the bottom, but what we do is I actually look into to see if there's any signs of dynamic exhaustion, because recently we still are seeing a lot of selling pressure in the market. And also in the near future, we have, as I've mentioned in the previous section, there are some liquidity crisis happening across the space. Whether or not the uncollateralized loan will be another threat to the development, the turn of this crypto bearish environment is very crucial, and probably I will look into more risks associated with uncollateralized loan, because I think they pose serious threat to the potential bullish development with the development, because these liquidity crises are so serious that if we don't fix them, or if this company keep going bankrupt and face insolvency, we won't expect a very quick comeback of bullish run. What do you think about that, Dave?
I think anyone, like any market players, they should address on the risk, potential risk associated with the current market, because the first one is pretty much like the Fed is doing quantitative tightening, that if the hawkish Fed is not signaling any sort of printing more money, or returning to money printing, or increasing the supply of M1, M2, that are going to have to provide more liquidity to the market. I think we still have to wait for the bullish run. So I think the second I would like to know is like what Johnny just said, is is there any sort of cascade event coming in the future about the reputation of borrowing or credibility are suffering from these uncollateralized loans, that if not people are not going to return the liquidity they borrowed, it's going to be a big issue that is going to trigger a cascade to like last time we saw ETH just hit down to the price of the $888. So next time probably lower. I don't predict pretty much, but I think average players or any sort of market players should take this sort of cascade event or prices drawdown into the account. So the third is what I predict, or I don't predict, because I think there are a lot of probabilities happening on the market. So what I do is I use the some sort of hedging techniques. So if there is a case, I can sort of showcase, or just talk about or illustrate how to do it. But I'll do a hedging with the a managing account to short the overhype in the tokens, and to long the over selling exhaustion tokens. For example, if in the bull market you short the ETH and long near, but in the bear market you sort of short near and long ETH, or you just short near, or you short tokens with higher beta. So to reduce the long exposure and increase the short protection probabilities. So that's pretty much how I think. Yeah.
Yeah, no, I mean, I think to summarize this, both of your guys' view, I mean, Hassan, feel free to jump in if you have any opinions. But I think from my perspective, definitely, I think everyone in the short term is really cautious right now. I mean, if you want a DCA, potentially now might be potentially a good time to start. But the key question is, how long potentially can you be dollar cost averaging into this I would say, bear market. I mean, we've dropped a significant amount. Don't get me wrong, for sure, right? 69K to now 20K ish. It's definitely a good level, and I think from that standpoint, it does take off a lot of the risk. But at the end of the day, as Dave kind of mentioned, end of the day, without the money printing go burr or any type of catalyst, so to speak, to kind of give us indication that the market is now kind of bottomed, and we're now more likely to see some new entrants and new buyers come in and step in. The likelihood and the bias right now is still probably to be more on the cautious side. And for some of you guys, that might be just shorting and doing some hedging, like Dave said. For others who are not as well versed in terms of trading, definitely be aware of using leverage and maybe just hold cash or maybe just trade less, right? Because right now, who knows? And in this environment, it's definitely better to be a little bit more safe and just protect your capital for now. So with that said, Hanson, do you have any thoughts on this?
My opinion is that we just have to be more patient, because we know that Fed's ultimate goal is to have continue raising rates until we see 2% inflation rate, and right now we're at 8.6%. So I think we might take years to reach that. So yeah, we need to be more impatient and do DCA if you want to.
Yeah, I would just denote that I don't think that probably they want to hike rates until we get to 2% inflation. I think they want to hike rates until they probably start seeing signs that inflation is slowing down. Because if they're going to hike rates until 2% inflation, I think we're going to see a complete destruction of global markets in general because of the amount of record debt globally, right? So with that said, again, as usual, thank you everyone for taking the time today to listen to us talk about the crypto markets in general. As usual, be sure to follow us at Huobi_research on Twitter, or definitely take a look at the number of different reports that we have on huobiresearch.medium.com. So as usual, thank you.